Welcome back to the deep dive. It's Sunday, January 25, 2026. And, I want to start today by just taking a hard look at the mythology of the startup world.
Mm-hmm. The garage, the hoodie.
Exactly. That whole idea, right? The brilliant idea on a napkin that just poof turns into a $1 billion exit.
It's a great story. We all love that
We
story.
do. But if you've been paying any attention to the private markets lately, you know that whole lottery ticket mentality. Just, throw money at 10 things and hope one hits.
Well,
That's pretty much on life support.
I'd go further. I think the spray and pray era, it's officially over. The math just doesn't work.
Exactly. And to get at what's replacing it, we're digging into a really fascinating case study today, the Ritz Group. Now, if you're in the Atlanta area or deep in private equity, you've probably heard the name. 40 years they've been around.
A long time.
But they just released this massive new thesis. They're calling it V3.0, the Venture Studio Model. And I want to be clear, this isn't just a rebrand. We're talking about a fundamental shift in how startups get built.
Yeah, it really is a shift from speculation to engineering. And the reason for it is kind of hidden in this one statistic from the source material that is just, honestly, it's brutal.
Okay, hit me with it.
Approximately 80% of private companies fail to reach an exit.
80%.
Wow.
So 4 out of 5 founders and their investors are basically just walking into a dead end. That is a staggering failure rate.
It is. And here's the kicker. This is what really struck me in the report. The sources claim this failure usually isn't because the product was bad. It's not, because the market didn't want the thing.
Which is what you always assume, right? The market just said no.
Exactly. But the data says it's almost entirely execution failure. It's cash flow mismanagement. It's a lack of experienced leadership. And it's what the Ritz Group calls a lack of exit-aligned operating discipline.
Exit-aligned operating discipline.
Basically, everyone is obsessed with the starting line, the launch, the logo, and nobody has a map to the finish line.
That is a perfect way to put it. We celebrate the launch. Nobody celebrates the 5-year gap analysis.
Because it's boring, but it's what keeps you alive. So our mission today is to unpack this pivot. The Ritz Group is moving from just connecting people to becoming a co-builder of companies. They're claiming this is the industrial revolution of the startup world.
Industrial revolution is a huge claim. That implies, moving from handcrafted to mass production. But before we get into the nuts and bolts of the factory, we need context. This group didn't just pop up yesterday.
That's right. To really get V3.0, you have to look at V1.0. The story starts way back in the 1980s. Originally, the Ritz Group was, well, exactly what it sounds like, a nonprofit networking thing based at the Ritz-Carlton in Atlanta.
Which just sounds so 1980s. I'm picturing big suits, martinis, a lot of handshakes.
Very much so. It was the Rolodex era.
Yeah.
The whole model was just curated access, get the right people in a luxury room, hope magic happens. And, that worked for a while. That was the model up until about 2011.
Then we get to 2012, and we're in the V2.0 era. The sources call this the creativity to capital phase. And this starts to feel a bit more like the startup world we know today.
Right. This is when it got structured. This is where they brought in the shark attack.
Which is their version of a pitch competition, I take it.
Exactly. And they went hard on this. Over 120 shows, 70 different sharks, more than 300 companies pitching. They also started angel clubs, Equity U for training. It was a whole ecosystem.
So here's the question then. If they had 300 companies pitching and angel clubs writing checks, why blow it all up? What was broken?
And the sources are really candid about this, which I found refreshing. They admit a huge flaw in the V2.0 model. They write, and I'm quoting here, capital access did not equate to capital effectiveness.
Oof. That is a heavy thing for an investment group to admit.
It is, but think about it. Just because I introduce you to an investor with a checkbook, that doesn't mean you actually know how to run a company.
Right.
You can have the best pitch in the world, but if you don't have the operational chops to survive the next 3 years, that money just vanishes.
It's like giving a teenager the keys to a Ferrari because they looked cool in the driver's seat.
And then being surprised when it's wrapped around a telephone pole.
Exactly.
The introduction, the capital, it wasn't enough.
So that's the founder side of the failure. But what about the investors? It's 2026. What's their biggest headache right now?
Oh, easy. 2 words. Liquidity trap.
Okay, unpack that for anyone listening who isn't, managing a hedge fund on the side.
Sure. So if you buy a public stock, Apple, Google, whatever, and tomorrow you want your money back, you just press a button on your phone. You sell. It's liquid.
You get cash right away.
Right. Private equity is the opposite. It is notoriously illiquid. You write a check to a startup, and that money is gone. It's trapped. The only way you get it back is an exit, an acquisition or an IPO.
And if we go back to that stat, 80% of companies are failing to exit.
Your money is stuck in a zombie company.
Yeah.
It's not dead enough to write off, but it's not alive enough to pay you back.
Yeah.
You can't recycle that capital. It's just dead weight.
So investors are just sitting on all this trapped capital that has to change how they look at new deals.
Completely. The sources say investors today in 2026 are just done with pretty pitch decks. They want to see proven leadership. They want to see people with successful exit experience. And they want monthly reporting on actual performance.
It sounds like the romance is gone. The accountants took over.
In a way.
Yeah.
But it's necessary. The old model incubators, accelerators, demo days, the Ritz thesis calls all that surface-level fixes. They don't solve the core execution problem.
Which brings us to their solution, the V3.0 Venture Studio model. Now, Venture Studio feels like a buzzword. How is this actually different from, say, Y Combinator?
The key difference is just the sheer level of involvement. An accelerator is, 3 months? It's like speed dating. You go in, you meet people, you do a demo day, and you're out. It's a matching model.
Kind of a good luck, hope you make it vibe.
Precisely. The Venture Studio is a co-creation model. It's like an arranged marriage where the parents move in with you. They stay engaged from formation all the way through the exit. They aren't just betting on the horse. They're training it, feeding it, and riding it.
And the goal isn't just growth, right? There was a phrase in the source material about their philosophy that really jumped out at me.
Yes, designing backward from the exit objective.
Designing backward, that's so interesting.
It's the complete opposite of how most founders think. Most founders go, let's build a cool thing and see what happens. The Venture Studio says, we want to sell this company in 5 years for $50 million. What do we need to do today to make that specific outcome happen?
So the exit isn't a happy accident. It's the engineered product.
Exactly. The goal is repeatable exits, redeployable capital in 5 years or less.
Which is an aggressive timeline, but I do want to clarify, did they just junk all the old stuff? The shark attacks, the angel clubs?
No, and this is the smart part. They kept all that as the legacy platform. The networking, the pitch events, they still happen. But now, they're the feeder system. It's how they find the talent and ideas to bring into the studio.
So they cast a wide net with the legacy stuff and then bring the best catches into the factory.
That's a good way to put it.
Okay, so you have this machine for engineering exits. But a machine needs operators. This is where the venture partner comes in. And the sources make a huge deal about this not being a mentor. Why is that distinction so important?
Oh, this is critical. We've all seen the mentor model. Some successful person has coffee with you once a month, gives you some generic advice.
Follow your passion. Hire slow, fire fast. High status volunteering.
Exactly. But that doesn't help when you have a cash flow crisis on a Tuesday. A Ritz venture partner is totally different. These are embedded executives. The source says they have shared operational accountability.
So they're actually working in the company.
Yes, and they have serious skin in the game. Their pay structure proves it. They get a salary, benefits, but they also get a safe for equity and performance bonuses that are targeting 7-figure exits.
That completely changes the dynamic. You're not just giving advice. Your own payout depends on it.
And look who these people are. The network has over 1,300 of them. The video source mentioned over 500 seasoned leaders in 30-plus cities. These aren't kids. These are people with previous exits, licensed broker-dealers, fund managers.
The source said they have an equity war chest. What does that mean?
It means they've made money before. They have their own capital, so they bring stability, and their own networks. It's almost like hiring a mercenary army of CEOs to drop into these startups.
A mercenary army of CEOs. I like that. Sounds intense.
It is, and they even generate their own revenue inside the ecosystem selling services, making sidecar investments. It creates this whole self-sustaining economy of talent.
Okay, so we have the model, we have the mercenaries. Let's talk weapons. Venture Labs sounds like where the real work happens. And they have something called the Capital Drill.
I love that name, the Capital Drill. It sounds like boot camp, and it pretty much is.
So what happens there?
It's a financial stress test. A really rigorous modeling framework, a 5-year gap analysis. It forces the startup to be disciplined with their numbers before they even see a dime of real institutional money.
So it finds the holes in the boat before you leave the harbor.
Exactly. It makes sure the roadmap to the exit is based on math, not just, hope.
And then on the total opposite end of that logic, they have the AI film studio.
Which is such a 2026 detail, right?
Yeah.
They're basically saying the elevator pitch is dead and the pitch deck is dying.
Wait, the pitch deck is dying. PowerPoint slide is like the holy scripture of Silicon Valley.
Not anymore, apparently. Attention spans are just too short. They're converting pitches into actual film assets. It's about cinematic storytelling to grab an investor's attention.
That makes a ton of sense. We live on screens.
Yeah.
Then there's Ritz Academy and something I found really practical, fractional CXOs.
Yeah, this is one of the smartest parts of the whole thing. If you're a tiny seed stage company, you cannot afford a $300,000 a year CFO.
But you desperately need that advice.
That's the paradox. So the fractional CXO model solves it. You get a CFO level expert for, say, 10 hours a week. It keeps your burn rate low, but the quality of decision-making really high.
Now, all of this, the partners, the startups, it has to be coordinated. And there's a piece of tech in the middle of it all called iMatch.
Yeah, think of iMatch as the engine room. It's an AI-driven platform built on a really simple idea: want versus have.
Okay, explain that.
Every member says what they have: skills, capital, services, and what they want: deal flow, CEO job, marketing help. The AI just runs 24/7 connecting the dots.
So it's basically a dating app for private equity.
A very, very sophisticated one. It says it delivers candidates in point scoring order to a dashboard. So it's not just a directory, it's actively ranking the best matches for you.
Which is huge. It automates the serendipity of networking.
Right, it turns the network into a transaction engine. And members can have unlimited sub-profiles. So one person could have a profile as a fractional CEO, another for their investment thesis, and even a storefront for their consulting services.
So we have the car, the driver, the GPS. Now we need the gas, the modern capital stack. How does this all get paid for?
This is where they close the loop. If a company makes it through the capital drill, that brutal diligence process, they get first access to the Ritz micro VC fund.
But one fund can't fuel this entire machine.
No, and it doesn't have to. They talk about grassroots capital. Remember those 1,300 venture partners?
Mercenaries.
Right. They all have their own Rolodexes. They bring their own investor networks to the table. So when a partner embeds in a company, they're not just bringing skills, they're bringing a potential funding network with them.
So it decentralizes the fundraising. You're not just pitching one fund.
Exactly. And they also mentioned future fintech stuff like fractionalization and internal liquidity pathways. It really seems like they're trying to build their own internal stock market to solve that illiquidity problem we started with.
To keep capital moving instead of letting it get trapped.
That's the ambition.
Yeah.
And honestly, it might be the only way to really solve the liquidity trap long term.
So let's just pull back for a second. We've gone from V1.0, shaking hands in a hotel, to V3.0, this highly engineered, AI-driven, co-building machine.
It's a profound shift. I think the best way to sum it up is they're trying to transform early-stage investing from a speculative asset class, which is just a fancy word for gambling, into a managed value creation system.
That distinction, going from a connector to a co-builder, that's what really sticks with me. For so long, the job was just to make the introduction, hey, you two should talk.
And then walk away.
Right. Now they're saying, we're getting in the trenches with you. We're looking at your spreadsheets. We are providing the C-suite, and we are going to make sure this thing works.
And for you listening, this matters. In a world with so much risk, the future really belongs to whoever can de-risk execution. This venture studio model, it might really be the industrial revolution of the startup world.
The industrialization of innovation? That's a fascinating and maybe a little intimidating way to put it, which brings me to one last thought I want to leave you with.
What's that?
If this studio model actually becomes the standard by, say, 2036, like the thesis predicts, what happens to the romantic idea of the garage startup?
That's a great question.
You know, if innovation becomes this predictable, this engineered, this corporate, do we lose some of the wildness? Do we lose the crazy outliers because they don't fit the capital drill? Or do we just stop wasting 80% of our best ideas on bad execution?
It's that classic tension, right? Efficiency versus serendipity.
Yeah.
I suspect we'd gain stability, but maybe lose a little bit of the soul.
Something to think about. That's it for this deep dive into the Ritz Group V3.0. Thanks for listening, and we'll catch you on the next one.